trying to make policy or avoid making policy as much as this massive internal strife was creating this huge distraction where you've got one faction battling against another faction. I mean, it paralyzed the institution to the peril of the American people, by the way. We paid the price for this crazy Machiavellian backbiting, saber in hand that was going on. That was completely unnecessary. I find it to have been an immense failure of the Biden administration to have dragged their feet for as long as they did. They've just held somebody who was confirmed by a vote of 80 votes in the Senate. They held that confirmation vote hostage for more than 3 months. Shame on Congress. And when they finally did get Brainerd get her vote through before Powell's, she only got 52 votes. So that tells you that one is a very partisan appointment, political appointee to the Federal Reserve Board, which is in violation of the Federal Reserve Act. They're supposed to be apolitical.
Correct, yeah.
And then they pushed another one through whose vote was required. Vice President Kamala Harris had to come in and cast the tie-breaking vote for Lisa Cook to get appointed to the Federal Reserve Board. So it's apparent to me that the politicization of the Fed has been toxic, and it has impaired the ability to make policy in a timely manner.
Yes, we discussed that last time, how you felt that the Fed was no longer keeping with the apolitical mandate. But now we have Powell confirmed.
We do.
And he feels a lot more secure in his position and is taking a much more aggressive stance against inflation.
He has veto power. So even though there is a group of people that gathers around a table for Federal Open Market Committee meetings, at the end of the day, it's the chair who has the most power.
And he is now saying that the Fed will not hesitate moving past broadly understood levels of neutral. So what does that mean? What is neutral?
Well, things started...
How high can rates go down?
Things started to break in 2018 once we were approaching 2.5%. And Powell had been very adamant back then that he wanted to get to 3%. Well, now that we're moving in 50 basis point, half a percentage point increments, we could theoretically get to the point that broke markets in 2018 just in the next 3 Fed meetings, June, July, September. And quantitative tightening will be fully ramped up by the time we get through August, because it's a 3-month ramp up to get to that $95 billion per month pace of quantitative tightening.
So what kind of interest rate could we be looking at then?
2.5%, 3% possibly. But again, you're seeing markets react quite violently to tightening financial conditions. You're seeing credit start to become disrupted. And that was the boogeyman that sidelined and Powell when push came to shove. So we're going to wait and see what all this time around he's willing to break. Because things are starting to break.
Well, former Fed Chair Ben Bernanke weighing in on all of this, and he is saying that the Fed waited too long to raise rates, and that the more the Fed raises rates, the higher the chances are of a recession, which is kind of standard information there, really. And that he sees that we're in a stagflationary period and that a recession is looking very, very likely. Is a recession inevitable at this point?
Well, first of all, let's clear the air, shall we? The original taper tantrum occurred under Ben Bernanke in 2013. So he knows a thing or two about backing down, being skittish, waiting too long. So if anything, because he started under Ben Bernanke, Jay Powell learned from him.
Slight level of hypocrisy making that
stylistically.
statement. Okay.
So yes, quite hypocritical coming from Ben Bernanke. He's right. And I think Jay Powell knows he's right. I think Jay Powell, since he was confirmed last Thursday, I don't know how many times I've heard him say the name Paul Volcker. And he knows very well that saying Paul Volcker is associated with the chair who put the U.S. economy into recession purposefully. And if we're getting echoes of that, then I would venture to say that Powell knows exactly what he's doing with full intent.
So he's still also insisting that a soft landing is possible.
Well, there is the job of the Federal Reserve Chair is also entails public relations. You don't come out and tell the exact truth, but he has alluded to the fact that he's not in control of every potential outcome. And when he said that a few days ago, markets got really upset.
So you see a recession starting in 2022? Well, what's your outlook on a recession and the timeline?
I mean, we've heard from Target today.
Yeah.
I think the retail sales figures that came out were very much of a head fake, because we're seeing such radical revisions to prior months that it almost feels like the retail sales data is being inflated. Because when you hear from a company on the ground that's the size of Target or Amazon.com a few weeks ago saying, we're not seeing as many sales as we did before, the US consumer is clearly being pinched, it would not surprise me if we were to see a second consecutive negative print in the current quarter that we're in that ends June 30th.
Well, you know, Danielle, you mentioned that part of Powell's job is to sugarcoat the truth a little bit. We are facing an issue of Fed credibility, though, especially with this transitory call. The likes of Mohamed El-Arian saying that the transitory call was the worst inflation call in the history of the Fed. So how much attention should we really be paying to the Fed? Should we be doing the opposite of what the Fed is signaling?
We are, but we're also seeing days when, you know, you'll check on the markets in the middle of the day if you're not paying complete and total attention. And you'll be like, oh, gee, the Dow's down 1,000 points. They're letting this happen. They're not getting in the way. When you have the most dovish of all Federal Reserve chairs, Mary Daly from the San Francisco Fed, which is traditionally the most dovish Fed. Of course, John Williams came from there, Janet Yellen herself came from there. When you have somebody like Mary Daly saying, we want for financial conditions to tighten further, that they're saying we want for the stock market to keep falling.
Okay, but the big mandate now, as Powell has made very clear, is to get inflation under control. But it wasn't just the Fed that got us into this inflationary mess. We had unprecedented monetary and fiscal stimulus.
Yes, we did.
We had people receiving helicopter money, as Ben Bernanke used to call it back in the day. People receiving endless jobless benefits, stimulus package after stimulus package. So does raising rates and tapering asset purchases, is that enough to bring down inflation? How effective is that going to be?
I think that because we're just about finished with tax refunds being dispersed, and there really is not another major source of cash coming to strapped U.S. households anytime soon, I certainly think that quantitative tightening and the impairment effect on the stock market, on the reverse wealth effect, which I do believe works in reverse, I think that coupled with inflation is certainly going to be enough to bring down inflation for goods and services. And we're already seeing American families canceling vacations. This whole idea that they were going to move their spending from goods to services, that narrative is breaking down.
But how long does it take to translate to real price decreases for products?
Well,
I mean, vacations, airlines, hotels.
We should ask Chair Powell, because we should ask Chair Powell about the stickiness of housing inflation that he caused. You note that when he's at the podium, he's, food inflation, Ukraine, and energy inflation. None of this is my fault. Bless his heart, because housing inflation is the Fed's fault. And we've seen higher prints in the consumer price index in this last one tied to shelter than we saw at the height of the housing bubble.
I certainly want to focus on housing, and we'll get to that in just a minute. But in terms of the Fed's actual ability to now bring down prices, okay, my hair product that I use has gone up by $3. Mm-hmm. At what point does it go back down, if ever?
And that's the good question, if ever. And I think that when you see pushback on the part of consumers, that they just stop buying things,
right,
that companies will be faced with having no choice at all. And that's why I think we're heading into not just what we're already in, which is an industrial recession. I think we're headed into an earnings recession, and pretty fast.
So do you see wages being decreased? As it is, we had wage increases which haven't been able to keep up with inflation. Do you see wage cuts?
I certainly see layoff announcements, and I see layoff announcements every day. Today was, company of the day today was Netflix. A few days ago, it was Twitter, Meta, Amazon. The layoff notices are multiplying. So as sure as night follows day, if people are losing their job, I would certainly think that their wage inflation has been crimped. And I think that we will see a faster reversal than people are anticipating in wage inflation, simply because there's going to be more supply out there, as in warm bodies.
So it's going to be a very painful period while that rebalancing hopefully occurs.
Yes. And again, I think the most critical differentiating factor compared to when the pandemic first hit is we're going into a very contentious election season.
Right.
So if push comes to shove, there's not fresh stimulus that's coming out of this Congress until February of 2023.
And that's probably a good thing, because as we say, stimulus is what got us into this mess in the first place.
Absolutely.
And you bring up the midterm elections, and because of that, there's been a lot of pressure from the Democrats to take a move regarding student loans. Now, President Biden, on the one hand, is saying that fighting inflation is his top priority. But on the other hand, it looks like the Biden administration is going to make a move with student loans, cutting them. And there seems to be a disconnect between government policy and monetary policy, because if we're going to put more money into the system by effectively wiping out 1.7 trillion of debt.
Oh, I don't think we're going to do that.
You think they're going to?
Oh.
There's currently 1.7 trillion debt owed by more than 40 million Americans. Now, granted, they haven't come up with a final proposal. They have said that there will be income thresholds, 150 below, to cut the debt. So it may not be that whole 1.7 trillion. But what impact, and again, they haven't said that they're definitively going to put something out there.
There's a reason for that.
Okay. You'll tell me that reason in a second. And also, nobody has actually paid back any student debt since the pandemic began. So let's keep that in mind. So what would the impact be then of this student debt now being canceled to one degree or another, especially as we're trying to fight inflation?
I don't think that it would be enormous at the margin, because it's been so long since anybody's had to make a payment that they've had this extra money in their budget. I would venture to say that most Americans are not squirreling away the payment that they would have made just in case. I think they are and have been spending this money, and that this has been stealth stimulus by that matter. The reason Biden is so hesitant to push through, and the reason Biden keeps suggesting, oh, maybe we'll take $10,000 and excuse that past a certain income threshold, is that there are already numerous ready-to-go class action lawsuits ready to go straight to the Supreme Court.
Right.
And this is a Supreme Court that would reverse that order in a heartbeat. And that's the reason that Biden is so hesitant. It's because the plaintiffs are already lined up.
Well, there is obviously the issue, putting aside for a minute the issue that it's deemed unfair to those that did actually have to pay back their student loans.
Every single penny.
Or those that opted to not go to college because they didn't want to get that kind of debt.
Right.
So it's the whole unfair argument here is one thing.
It's moral hazard writ large. And I ask the administration, what are they going to do? I think there was another $14 billion of student debt that was put on just in a recent month. What are they going to do with new applicants?
Right.
And that's why I think legally they're having such a hard time.
Yeah, why
if
is
you
it
try
fair?
and excuse it, does that mean you're shutting it down for future students?
Yeah.
So it's a mess, which is why Biden continues to deflect and suggest that he's going to go after big bad corporations,
right,
for causing inflation, instead of looking in the mirror and realizing it fiscal policy that he added fuel to the fire that Donald Trump set to begin with.
Well, there is obviously a debate whether the president can do this via executive order or whether Congress is necessary for this process. Some people in the Democratic Party, like Senator Bernie Sanders and Elizabeth Warren, they're suggesting that this can be done through executive order. But then to your point, this would be one of the issues that goes up to the Supreme Court.
Quickly.
But in terms of the impact that that's having on the economy, you're saying that it's already there just because people have sort of taken for granted that they don't have to pay their student debt, and there's been a pause on that.
Of course. I mean, I don't think that there's any coincidence in the expiration of this other moratorium, because there's been one after another, being August 30th. So he'll make some kind of announcement right before the election.
Well, speaking of President Biden and big corporations, inflation has been a hot topic of debate on Twitter between the president and a couple of billionaires. Biden tweeted recently, "You want to bring down inflation, let's make sure that the wealthiest corporations pay their fair share." And that brought Elon Musk and Jeff Bezos into the fray.
The obvious reason for inflation is that the government printed a zillion amount of more money than it had, obviously.
Well, putting Musk aside for a second, Bezos went straight on, taking on President Biden's Twitter account, saying that the inflation is a regressive tax, that most hurts the least affluent, and that misdirection doesn't help the country. So he's accusing the White House of muddying the waters. He said, understandably, they want to muddy the topic. They know inflation hurts the neediest the most, but unions aren't causing inflation, and neither are wealthy people. Remember, the administration tried their best to add another $3.5 trillion to federal spending. They failed, but if they had succeeded, inflation would be even higher than it is today, and inflation today is at a 40-year high. And then Bezos credits Manchin from saving the country from this extra bit of stimulus.
It's taking every bit of self-restraint that I have to not run and retweet all of this, because he's absolutely spot on, 100% correct. And we're not stupid. We cannot be simply misdirected. Life does not occur according to some delusional script coming out of the White House. And this has nothing to do with anything that the administration is suggesting it does.
So it's actually very interesting because Bezos, who's also the owner of the Washington Post, which is typically very friendly, shall we say, to Democrats and Democratic agendas, coming out.
That's a diplomatic way of saying it, yes.
Yeah, coming out and taking this approach. And he actually said, in a tweet, which I thought was quite funny, that the new Department of Disinformation should take a look at President Biden's claim that by corporations paying their fair tax, that's a way to bring down inflation. So let's get your take on this from a purely factual point of view. If the wealthiest corporations pay their fair share, or we have tax reform, does that help with bringing down inflation?
No, that's ridiculous. It's good if we have a minimum across the board flat tax for employees so that they pay their fair share of taxes. I believe in that. I believe in simplifying the tax code for individuals and corporations. But that's hooey. That's a nice word.
All right, so making sure corporations and billionaires pay more does not help with the inflation problem, and you agree that that is serious misdirection by the Biden administration.
I'll go back to my polite word of delusional.
Okay, delusional, hooey. You've thrown out some choice words here today, Danielle. Okay, but look, to be fair, the inflation problem is not just in the US. We have the UK recently coming out that they have inflation at a 40-year high of 9%. Canada's inflation rate hit a new 31-year high, 6.8% in April. So it's clearly a bigger global issue. Mm-hmm. Is that perhaps a positive in the sense that it's not just a US problem and we could see some central bank coordination in trying to solve this?
I don't think it's a positive.
Like it's not just our problem in the US.
Well, bully for us. No. I think a lot of the inflation that you're seeing overseas keys off of the fact that other countries import even more of their energy. And as far as runaway inflation in Canada, for heaven's sake, it's where we're sitting as one of the biggest housing bubbles in the history of mankind. So that also has been fueled by inappropriately easy monetary policy. That's not good. So having company when you're in hell is just not a good place to be.
I don't know, maybe I'm a misery loves company kind of person. But do we at least get to see some central bank coordination in terms of tackling this?
I think that we will see it to a certain extent, but I don't know how strong Christine Lagarde's resolve is going to be, because it's quite apparent that Germany is already in recession. So it's going to be increasingly difficult to push through with tightening monetary policy in other countries that are already further along in their process of falling into recession.
Okay, so no central bank coordination necessarily.
I think that central banks will be as hawkish as they can be.
Right.
But again, once we start to see that unemployment rate tick up, it's very difficult to hold your ground.
Look, the rising energy prices can't blame the Fed for that. to a degree, that's bad policies in terms of climate change, lack of investment into oil and gas companies due to ESG concerns. So the sector in itself hasn't been flourishing in the US, as we know, one of the first things that the Biden administration did.
Is any of it their fault? I mean, did Americans have a lot more money because the Fed monetized every single penny of fiscal stimulus? Did Americans have more money to buy great big SUVs that they now have to fill up with gas? So, I mean, in a way, I mean, you can excuse some of it, but not all of it.
No, I'm certainly not laying the groundwork for excusing the Fed. I'm just saying that as far as oil prices go, you have those factors which are policy factors, climate change factors, and then of course you also have this Russia's invasion of Ukraine, which threw everything for a loop. But what you have made very, very clear is that you do hold the Fed very much accountable for the runaway housing speculation.
Oh, gosh. Yes. Look, when you have a company like CoreLogic, very respected housing data producer, come out and say that a third of all transactions in the country are by investors playing with all cash, I mean, that is the fruits of speculation that overly easing monetary policy fed. Monetary policy fed housing speculation. And that lies right at the door of Jerome Powell. And you don't get this frenzied level of interest unless you've got this investor class who's making it so difficult for the average American to buy a home that they feel like they have to engage in bidding wars. And bidding wars are things that feed upon themselves. And people talk about it. Oh gosh, I'm going to overbid by this much. I'm going to overbid by that. It's a process that the Fed fed.
All right. So now that the Fed is taking a different approach, there are concerns that we're going to see another housing collapse. What's your outlook there?
We certainly are seeing it slow down and slow down fast. You know, we have, I think the latest data is 61% of all mortgage lenders are laying off their staff right now, reducing headcount. We've got more homes under construction than any time since 1973. So the next time we see each other at one of these happy gatherings, we'll be talking about oversupply in housing. And when was the last time anybody talked about oversupply in housing? But 4 out of the last 5 months, we've seen 1 million homes come complete. Well, that's very unusual. So, and mortgage rates are where they are. So affordability has never been as pinched as it is. Your average mortgage payment in the United States is up 39% year over year. Thank you, Jay Powell. So, but we are seeing a very sudden slowdown in the housing market.
But there's no concern of a housing market crash like we saw in 2008. Would it be that severe, especially considering that the banks are better positioned to deal with that?
The banks are better positioned, but we've certainly seen a good number of FHA lending where people only have the 3.5% down, and we've seen many. I mean, we've seen tremendous activity in second home sales. That's completely crashed in the space of 3-4 months.
So how bad is the potential housing market crash? Paint me a picture here. And how do you see it playing out?
If you're an average American and housing housing used to be the biggest line item on your balance sheet, but all of a sudden the stock market became an even bigger line item on your balance sheet. What if they start to come down? Or what if the stock market comes down? Oh wait, it has. So if you own 2 homes in America, and many, many, many baby boomers did go out and buy second homes after the pandemic hit. So if your stock market portfolio is in a meltdown mode and you own 2 homes and you have 2 mortgages, what are the implications? You're going to monetize one to batten down the hatches and make sure you don't have to work for 10 more years.
Right.
So we could see a rush of supply into the housing market, and we've already seen evidence that home price appreciation has begun to slow.
Begun to slow, and I understand it's different per area and sector,
of course.
Obviously.
Location.
But if you were to hazard a guess in terms of a percentage decline in the U.S. housing sector at large, where do you see that going?
Oh gosh, I mean, it's so hard to see because we've still got double-digit home price inflation, and home price inflation follows the supply that we're seeing come online. But I certainly think that 2023 could be a year that we see a negative sign nationwide in front of home prices.
All right, 2023 is when the housing market is really going to start to feel that.
Well, you'll feel it now, because, and you're hearing it from the few honest realtors in existence. You're hearing that the bidding wars have ebbed. You're hearing that people are lucky to sell their home. So while there's still going to be pockets of hotness, and it takes a long time for the narrative to change,
Right.
especially for your average home buyer, the message is coming through loud and clear.
So, Danielle, we always like to give our viewers actual useful advice in terms of what they can do in this scenario, because how does one position one's portfolio to deal with what's coming ahead?
These days I'm looking at farmland as an investable asset.
Okay, you and Bill Gates.
Well, yes. I mean, the United States is by far the most productive nation in the world in terms of the yield that we get per acre that's planted, and it's got great diversification. Gold has not done as well as I would have hoped that it would have, but I'm sure as hell not selling it. And then there's that other elephant in the room if you want to ask me about it.
Oh, Bitcoin. We'll get to Bitcoin, but let's break down gold in a second, because we have seen interest rates rising and the price of gold essentially stay flat. In fact, there's been a divergence between the peak of gold and how interest rates have been rising. So what is happening there? Why is gold not reacting to interest rates? Is it purely a US dollar strength situation?
That's certainly one of the biggest factors. And that you are seeing that reflected in gold. I would add, however, that the closer Jay Powell gets to succeeding in putting the U.S. economy into a recession, the more disruption you see in financial markets, the harder the floor is going to be underneath that gold price. And the more the impetus, if it looks like we're going to segue from a recession to a crisis, from a recession to a financial crisis, where something in the credit market starts to break,